Good afternoon, everybody. My name's Phil Johns. I'm a senior financial planner in our Exeter office, and I'm here today to have a quick chat with you about, firstly, the markets, past, present, and future, and then how financial planners can help charities. So, market update. As you'll all be very aware, it's been quite a challenging time in the UK economy. And what I thought I'd do is just look back first over the last 18 months of where we've been, and have a look at several different things that have happened in the market and what's led us to where we are. First of all, some reference points for you. Around here is where the Ukrainian conflict started, and you can see up here inflation starting to rage away over that 18-month period, culminating in the end of A at the end there. At the same time, behind this, we've got interest rates starting to tick up all the way through last year, which have been problematic for the bond markets, as we can see down here. So from that point of view, we've had a number of headwinds in the market, which have led to a reasonable degree of underperformance from things like government gilts, which is the pink line down the bottom, and worldwide stock markets haven't really favoured that well over that period either. So traditionally, what we've seen in the market is if we've got um, gilts, so the pink line going down, then equities would normally have gone up. Unfortunately, last year, for the first time in 40 years, we've had gilts and equities going down, as we can see through the early part of January 22 and through 22. Equity and bond markets were both down quite significantly. What's led to the bigger drop in gilts is the rapid rise of inflation, along with a rapid rise in interest rates, which has really hurt the economies of the world going forward. So it's not been a fantastic 12-month period or 18-month period. If we kind of take a step back though and sort of say, okay, well, investing is never a 18-month situation in any case. What would it look like if we went back 3 years? This chart shows you from January 2020 up until now, and what has happened in the markets in that time. So we've kind of covered off this part in the slide before. What we didn't have before, though, is this massive spike down from the COVID pandemic, which really hurt equity markets around the world. We had people on furlough. Anyway, everybody knows that story. But what's interesting to see here is that government gilts around here had a bit of a blip when the pandemic happened, but largely continued unaffected by the markets or by the world events. In fact, governments were borrowing more money in that time to prop up furlough and provide helicopter money in the States, things like that, where equity markets fared quite badly to start with, but then recovered quite quickly, and in the US's case, actually ramped away with rapid growth due to tech stocks. All the while, this sleeping giant of inflation has been creeping along and creeping up. And the background story here is that the markets thought this was transitional. Everyone was locked down, so no one spent any money. Everyone came out and spent a load of money that they'd saved during lockdown, and then everyone thought it would calm down. Obviously, the events in the Ukraine have played into that, and the energy crisis that we've suffered as a result of it has then led on to higher inflation throughout the supply chains, and a cost of living crisis, which we're all feeling now. So again, as I said, looking further back than that, if we look back to 2013, what you can really see now is that what's happened over the last 3 years is starting to look like a little bit. It's still a big blip, don't get me wrong, around here, but it will smooth itself out as markets, as time moves on. So what it demonstrates, and what we tend to advocate to clients, is to have a diversified portfolio, so that you're not picking to just be in a cautious mandate, which is I suppose, government gilts, which is what the FCA would have everyone buying if you said you were cautious. Over the last 12, 18 months, they've lost 34%, as against equity markets between the UK, Europe, and US down here, who over that time period have actually pulled forward quite well. So when you are a charity that's investing monies for future projects, the time scale involved in that investment is vitally important, and assessing what risk you can take within that period. Now, it's a bit of a gloomy outlook that I've produced there. So, in terms of present situations, I suppose, that we've got coming forward, we've had the US debt ceiling negotiations, which I'm pleased to say have passed, and the US is now no longer in a position where it may default, which is very comforting to the markets. In terms of the UK, we are going to continue to see interest rates going up across the UK to battle inflation, which has, broadly speaking, stood still over the last month. The trend of rising interest rates will continue from the Bank of England. Um, Later on in the year, we're likely to see the US, UK, Germany is, technically speaking, in a mild recession already. With the raising of interest rates, it tends to slow down the economic activity across all markets. And what we're seeing is likely to be technical recessions in the UK. So it's not going to be a huge recession, but it might only be a couple of basis points that GDP falls by. But it's still a recession nonetheless. Of more concern, latterly, especially with the cost of living crisis as well, is the fact that interest rates are now having a bigger effect on the UK property market. So we're starting to see house prices fall for the first time in a long time, more significantly, and the cost of borrowing to the public is getting increasingly higher, and the quality or the number of mortgage offers that are available are reducing from suppliers. So lenders aren't wanting to lend as much; they're tightening their lending criteria. And actually, the interest rates are starting to become unaffordable for people. So we may well see a bit more pain coming in the property market across this year. The reason it's been slightly delayed, bearing in mind interest rates have been going up for the last 12 months, at least, is because most of the UK's mortgage market is on a 2-year or 5-year fixed rate. So as and when those deals come to an end, we have a cohort of people that are going to be exposed to significantly higher interest rates than they're used to. So this may put some stress into the property market. What are we looking at for the future? So the consensus currently is that the US interest rates will likely hold now at the level they're at. The last thing they really want to do is push themselves further into what could be a recession. So I think the Federal Reserve has finished its rate rises depending on the market data that it gets back, and we may even see a fall in interest rates in Q1 of 2024. In the UK, interest rates will carry on going up for the coming months, with a likely fall in May, in kind of Q2 2024. As inflation was stickier last month, that's perhaps latter in Q2, perhaps close to Q3 now. Unfortunately, that all feeds into the cost of living crisis in the UK continuing to be a problem, and people's, I suppose, household budgets being squeezed more and more. There is a little relief in the form of energy prices coming down, but they're not coming down fast enough to make up for the fact that interest rates have gone up. Also, we have, I suppose, a geopolitical risks coming to us in the form of UK general election potentially next year, and a US presidential race in November next year. These things aren't necessarily risks in themselves, but they provide an element of uncertainty around taxation, and that in itself breeds uncertainty into the markets as to what profits are going to be taxed at. So the markets will react accordingly. So what does this mean for yourselves as charities? unfortunately, it's not great reading in terms of donations. They're already down by over 1 billion between 2021 and 2020. On the plus side, 1 in 3 people did donate to the Ukrainian crisis, which is kind of it's good to see. But the cost of living crisis does mean people are cutting back on donations both in the street and by direct debit. So people are actively reviewing their household budgets and saying, okay, we can't afford to give money away now, unfortunately. And on a finish on a high, um, in the UK, we seem to love our animals, so animal welfare charities remain the most popular causes to donate to. So, how can financial planners help charities? Um, what we can do, I suppose, rather than standing here and saying Francis Clark Financial Planning obviously are the best financial planners in the region, and you should come to us. I thought it would be helpful for you to know what to look for if you're looking for a financial planning business to help your charity. We'd always advocate using a chartered firm who are independent. The reason we say this is because if it's a chartered firm, then they subscribe to the highest qualifications. If they're independent, we have no bias towards any one provider. So it means our due diligence is very robust. We review the whole of market all of the time. You also may want to look for a firm that's experienced in helping charities to invest. And by having all of these things in their DNA, if you like, it means that we act in the best interests of the charity itself, rather than what your business can do for us. So, um, one of the biggest things that we can help with, or the biggest thing, is we can help you review or construct an investment policy for your charity. If you've got an investment policy, fantastic. If you haven't and you're doing any kind of cash management, then you should have a basic investment policy in place already. And what does an investment policy do? It effectively sets out the goals for your charity in terms of investment objective, and having a clear strategy to achieve your goals. It documents your risk appetite, and the amount to be invested over what time horizon. So it effectively means that if the Charities Commission or a trustee or a donor comes and asks a question about it, you can hand over the investment policy and say, this gives you all the information you need to know about how we invest and why we invest. Now, there are a couple of parts which kind of which require a bit more explanation. One being types of investment. Now, there has been a lot of legal challenge around where charities can invest, and the idea that actually charities are supposed to invest to make the biggest bang for its buck, if that makes sense, rather than applying some kind of ethical screening to an investment policy. There's been some recent challenges in law around this, and actually we've had a High Court judge that's turned around and said that actually a charity can invest according to its beliefs. And now, what does that mean to you? It means that actually, if you're an animal welfare charity, you may turn around and say, we want to exclude certain types of investment or companies from the investments that you make. So you may turn around and say, we don't want to have any kind of animal testing companies within our investment portfolio. So you might remove companies like L'Oreal, or Estee Lauder, people like that who are animal testing for cosmetic reasons. But on the flip side, you may want to include pharmaceutical companies who do animal testing, on the basis that if you're an animal welfare charity, you may well give some of your animals drugs which help them recover from domestic abuse or any kind of ailment that they've got. Now, some of those drugs will have been tested on animals, but the animals are actually benefiting from them, so they want them included within that investment mandate. So it's about kind of understanding where your values are and what types of investment and investment companies you want to be included within your investment mandate. Now, we'll help you drill down in that space and understand exactly what you want to achieve from your investments to make it as appropriate to your charity as possible. Um, so that's where we get to there. So as once we've really fleshed out your investment policy and helped you uh, guide that down, um, we'll help you appoint an investment manager. Now, what we don't profess that you're going to be experts in looking at the world of investment management and finding out who's the best investment manager for your investment portfolio. So we will go away and research the market to identify suitable providers that can meet your investment policy. So we'll act on your behalf to conduct detailed and rigorous due diligence to make sure that if anybody does challenge what you're doing as trustees, we've got all the evidence to support you in showing why we selected a certain individual company over another. We'll also run a selection process with you if you want to, so that you can review the options of investment managers firsthand. And we sit on your side of the table to ask difficult questions of them. So, from that point of view, we are on the charity side, trying to help you to understand exactly what these investment managers do, why they do it, and what the costs are involved in it. So once you've got your investment policy and you've appointed an investment manager, one of the most important things to do is to review that investment on at least a minimum of an annual basis, to ensure adherence to Charity Commission guidelines and to amend your investment policy as required. Um, we want to review the investments at least once a year so that they make sure they're in line with your investment policy, checking the performance against the agreed benchmarks with the investment manager. If it's not meeting those benchmarks, asking the difficult questions as to why. There may well be a perfectly good reason for it, but we need to understand exactly what's gone on to have missed those benchmarks. Um, and to provide a review document for the charity's files so that you're in adherence with the governance set out for you. Now, what we'd also suggest is every 3 years we would conduct a discretionary manager market review. So we'd go out to the wider market again and essentially tender for your mandate to make sure that we've got the most appropriate investment manager for your charity's investment. So, in summary, financial planners can help provide a charity with independent expert guidance surrounding the charity's investments. We provide you with a peace of mind that the trustees, the charities of funds are appropriately invested in line with their stated investment policy, and the investment policy and funds are reviewed on a regular basis and updated as required. We also help provide you with evidence to support the trustees and the investment choices made and make sure they're in the best interests of the charity. If anybody has any questions, then please send them through and we'll endeavour to come back to you with an answer as soon as we can. Thank you very much.